Artificial intelligence is everywhere, and the companies building its foundational technology are reporting some massive numbers. One chip giant that just dropped a seriously strong earnings report is Qualcomm. But here's the twist. They posted a multi-billion-dollar loss. So what's the real story? Is this a red flag or a golden buying opportunity? Welcome back to the channel. Today, we're doing a deep dive into Qualcomm's fourth quarter fiscal 2025 results to see if this stock deserves a spot in your portfolio. Let's break it down. Qualcomm Incorporated, ticker QCOM, is a global leader in the semiconductor and telecommunications industry, fundamentally known for inventing and commercializing the foundational technologies that power modern wireless communications, particularly in 5G. The company's core business revolves around the development and licensing of its extensive portfolio of intellectual property, including critical patents for CDMA and OFDMA, which are essential to 3G, 4G, and 5G standards. A significant portion of its revenue is generated through QTL, Qualcomm Technology Licensing, where it licenses these technologies to a vast array of handset makers and other device manufacturers. Complementing this, its QCT segment designs and sells system-on-chip or SoC semiconductors and software, primarily Snapdragon platforms, which integrate CPUs, GPUs, modems, and AI processors for smartphones, automotive systems, IoT devices, and other smart connected devices. First, let's look at the headline numbers that got everyone's attention. For Q4 2025, Qualcomm delivered a clean beat. Revenue came in at $11.27 billion, surging 10% year-over-year and beating analyst forecasts of $10.75 billion. Even more impressive, their earnings per share was $3 on a non-GAAP basis, comfortably above the $2.87 that Wall Street was expecting. The market liked what they saw, sending the stock up over 3.5% in after-hours trading. But here's the twist. They posted a multi-billion-dollar loss. So what's the real story? Is this a red flag or a golden buying opportunity? The real story here isn't just about beating estimates. It's about where the growth is coming from. The core of Qualcomm's business is its QCT segment, which sells chips, and it grew a robust 13% to $9.8 billion. Now let's break that down. Handsets, the traditional bread and butter. Revenue here was strong, up 14% annually, showing the mobile market remains healthy. Automotive. This is a major highlight. Qualcomm hit a huge milestone, with automotive revenue soaring past $1 billion for the first time ever in a single quarter. That's a record and a sign they're becoming a dominant force in car tech. Internet of Things, IoT revenue was also on fire, growing 22% year-over-year. When you combine auto and IoT, you get a staggering 27% growth rate. This tells us Qualcomm's strategy to diversify beyond smartphones is not just working, it's accelerating. Now, let's address that multi-billion-dollar loss I mentioned. You might have seen headlines that Qualcomm reported a GAAP net loss of $3.1 billion. Before you panic, you need to know this was due to a one-time $5.7 billion non-cash charge related to new U.S. tax legislation. This is an accounting entry, not a reflection of their business performance. In fact, operationally, the company is incredibly healthy, generating a record $12.8 billion in free cash flow for the full year. But perhaps the most bullish signal of all came from management's guidance for the next quarter. They're forecasting Q1 2026 revenue between $11.8 and $12.6 billion, and EPS between $3.30 and $3.50. Both are significantly above what analysts were predicting, showing immense confidence in their future. CEO Cristiano Amon emphasized their momentum in automotive, IoT, data centers, and crucially, AI-driven applications. With the launch of new products like the Snapdragon 8 Elite Gen 5 platform, they're pushing the boundaries of on-device AI. Let's talk about the bull case, the reasons for optimism. First, diversification is paying off. Qualcomm is no longer just a handset company. Their automotive revenue has now surpassed $1 billion per quarter, and combined with IoT, these segments are growing at an impressive 27%. This creates a more resilient business, less dependent on the volatile smartphone cycle. Second, and this is the big one, AI is their new growth engine. They are a key player in the emerging AI PC space with their Snapdragon X series chips, and they're making a serious push into the data center with power-efficient chips designed for AI inference. Management's multi-year AI strategy is clear. Dominate at the edge. That's your laptop, your car, smart factories, and even robotics. Third, their core business remains strong. The premium Android market, powered by their flagship Snapdragon 8 Elite Gen 5 chip, continues to deliver solid results. And strategic moves like the acquisition of Arduino are building a powerful developer ecosystem to accelerate edge AI adoption. Finally, they are a financial powerhouse, generating strong free cash flow. This allows them to reinvest in innovation while also returning money to shareholders through dividends and buybacks, a sign of a healthy, mature company.
However, to get a complete picture, we must look at the significant risks and challenges. The biggest threat is customer concentration. Qualcomm's fortunes are heavily tied to a few key partners. Apple continues its long-rumored project to develop in-house modem technology, which could eventually remove a massive customer. Relationships with Samsung and other Android OEMs are also constantly evolving and subject to intense negotiation. Then there's fierce competition. They're not just fighting MediaTek in mobile. In AI and data centers, they're up against giants like NVIDIA, Intel, and Broadcom, not to mention emerging low-cost Chinese chip makers. There are also external pressures. Regulatory scrutiny over acquisitions and the ongoing trade tensions with China create persistent uncertainty. And perhaps the most immediate concern? Execution. Successfully scaling new, complex businesses like data center chips and industrial IoT is difficult. Any misstep here could delay their growth trajectory. Furthermore, while their core is strong, any unexpected softness in global smartphone demand would still hurt their bottom line. One final note for investors. Keep an eye on their earnings reports. Large non-cash tax charges have been impacting their GAAP earnings lately, which can spook some investors and overshadow an otherwise strong operational performance. For income investors, its real appeal lies in its outstanding dividend track record. Here are the key facts. The company has not just paid, but consistently increased its dividend for 22 consecutive years. That's a commitment to shareholders that spans multiple market cycles. Right now, the quarterly dividend sits at 89 cents per share, which annualizes to $3.56 per share. At that rate, Qualcomm offers a very attractive dividend yield of around 2.1%. In a tech sector where dividends are often scarce or minuscule, that yield stands out.
But a high yield isn't worth much if it's not sustainable. This is where Qualcomm truly shines. Let's look at the financial health behind the dividend. The most critical metric here is the payout ratio, the percentage of earnings paid out as dividends. For Qualcomm, this ratio is a very healthy 33 to 35%. What does this mean for you as an investor? A low payout ratio tells us two things. The dividend is extremely safe. The company earns more than enough to cover its payments with a significant cushion. It retains the majority of its profits to reinvest in innovation, funding future growth in AI, IoT, and automotive tech. This balance is the holy grail for dividend growth investors. Furthermore, Qualcomm boasts strong free cash flow and stable earnings, which are the engines that fuel reliable dividend increases. In fact, the dividend has been growing at a rate of about 5% annually. This impressive combination of safety and growth hasn't gone unnoticed. Qualcomm has earned a spot on the Dividend Channel's Safe 25 list, a curated selection of stocks known for their exceptional dividend reliability. With a 22-year history of increases, a sustainable payout ratio, a yield that beats many of its tech peers, and a solid financial foundation, Qualcomm presents a compelling case for investors seeking both income and exposure to the growing semiconductor sector. It's a dividend stock that allows you to get paid while you wait for its next wave of innovation. Following their recent earnings call, the general analyst outlook for Qualcomm is positive. The consensus rating among roughly 20 to 30 analysts leans towards a buy or moderate buy. The average price target sits between $185 and $190. With the stock trading around $171, That implies a potential upside of roughly 10% or more from current levels. So the baseline message from the street is optimistic. This bullish sentiment is reflected in some of the higher price targets we've seen. For instance, JP Morgan holds an overweight rating with a target of $210. Rosenblatt Securities is even more optimistic, maintaining a buy with a target of $225. And just recently, BOA Securities increased its price target to $215. These targets suggest a conviction that there's significant room for QCOM to run. Some firms, like UBS, maintain a neutral rating, even though they raised their price target to $185. The primary reason for this caution was a large non-cash tax charge that impacted the company's GAAP earnings. This wasn't a reflection of their ongoing business health, but it's a headline number that can cause some near-term uncertainty. So, while the operational business is strong, this one-time event is the main reason you're not seeing a universal, roaring strong buy from every single analyst. What do you think? Is Qualcomm a buy in your portfolio? Let us know in the comments below.